Okay, we're on. We're recording. Remember, everyone, to keep your cameras off and to not unmute yourself unless we give you permission. This morning I have with us Mr. Patrick Price, who is with the IRS, and he's been with us now, I think this might be the third or fourth year, I can't remember. But I'm going to let him do some introductory pieces about himself if he likes before he actually does his presentation on the federal IRS law update. So I am going to go into presentation mode. Patrick, go ahead and introduce yourself.
Yeah, this is probably the fifth year at least. I don't know.
Okay.
Whenever Diana retired and I took over, is when I picked up AARP. So those of you who don't know me, I'm Patrick Price. I'm the tax consultant here in well, now we're called the Pittsburgh branch, which is basically Western Pennsylvania, which is where you guys are. Last year we were pretty short on tax consultants, at least here in Pittsburgh. It was just me. So I was trying to do everything, and some of the stuff the people in Philly picked up. Well, now they hired two new people back in the late spring, and they hired another person in the summertime. So now we're back to three full-time tax consultants.
Okay.
So what I've been trying to do is just have you guys deal with me for your issues, but for some of this stuff, maybe the site reviews or something like that, you might deal with Joyce or Valerie, just for them to conduct the review. Because it shouldn't matter who the tax consultant is that conduct the review. Okay, that's the basic slide, and this is pretty much the same presentation. I've been updating it and fixing it from year to year. So if it looks similar to what you guys saw last year or whatever, well, it's because I keep updating. Okay, we can go to the next slide. Okay, some administrative issues. Well, you guys have to adhere to the quality site requirements, and you and your people must also adhere to the volunteer standards of conduct. That information is in the publication 1084, which is Site Coordinator Handbook. There's also publication 5151, which goes into depth on examples and stuff about the quality site requirements. What the quality site requirements are, that security issues, making sure all your people are certified, things of that nature. There's, they're like the 10 commandments, okay? And then the standards of conduct, of course, are your common sense stuff. Don't protect people's information, don't share their information with other people, don't offer to have refunds deposited, where they're not supposed to go, all that type of stuff. As far as site visits and remote reviews go, well, this year they've told us we don't have any travel money. So, because we don't have any travel money, we ain't coming out to visit you guys. So, site reviews, as far as done by the Pittsburgh branch, will be remote reviews. So what we will do is IRS will select who they want to be reviewed, and then we'll contact you and say, we need to do a remote review. When's a good time for you? Because you don't have to do the review at the time when the site is open, or if you want to do it on an off day or in the afternoon or something like that that's easier for you, that's fine. It's not like, a in-person review where we would show up and, while you're actually there. So the tax consultant will contact you, we'll set up a time and a date, and then they'll call you, or they'll call you, and then they'll go over the review. And that takes about around about 15 minutes, because it's basically just all the information that we're going to ask you is in the publication 1084 on Form 6749D. So what you should do is, with the 6729D, is to, after you have your site opened up, pull that form from the Site Coordinator Handbook. It's the site review sheet. And then make sure you have all the stuff there that the IRS is looking for. So there should be no surprises when we talk to you about, how are you doing this or something like that, because you know all the questions up front that they're going to ask. Now, there are a couple things that are different between AARP and VITA, such as like posters and stuff like that. The form will list the VITA forms, but you guys use your D143 poster, and that covers you for both Voltax and for civil rights. So you only need to have one poster at the entrance to the site. I know when I've looked at people's forms order here, they're ordering all kinds of stuff, but you guys don't need all kinds of stuff. All you need really are records, envelope. Well, you don't even need that. You need 4012s and test booklets. That's a 6744. Any of the other stuff on there? Really? Somebody's gonna call me? Just a minute. I've got my IRS computer up too at the same time, so I let it go off. Okay. I'll get back to whoever that person is. All right. But site visits. Now, from what I've been told, IRS headquarter people and the Treasury Inspector General may be out there in person. So if they show up, they'll either, show up and present their credentials and stuff like that right away, or they may be there pretending to be a taxpayer and go through your process, and then they'll show who they are after the the return's been completed and stuff. So, but the Inspector General only does like 36 to 39 visits a year, and that's nationwide. So probably pretty much one per state or whatever. So, but the IRS shoppers, I mean, we don't know if they have money to travel yet at this point, but from what I've heard, they probably will be out there. The software, a little bit different. What I did with AARP this year was to reach out to Trish and Sue and Frank and said to them, okay, tell me the sites that are definitely going to be open that need software. And then I need to know who the site coordinator is, and local coordinator, and who the person is receiving the software, because that's all is required to put the order in. What we're trying to avoid is like last year where we ordered a bunch of software and then sites weren't able to be open because of the virus and all these other issues. And then it was a fiasco to try to swap to other places, return software, and stuff like that. And they just want to avoid all that this year with, sites making a firm commitment that they will be open. Granted, there's always some last minute thing that happens. Somebody gets sick or the center can't open or whatever, and we have to, swap that software or return it or something, but they want to keep that down much more than what it was last year. Return minimums, we're not going to give you software unless your site does 100 returns. That's the reality there, because it costs the IRS around $550 for the software. They're looking at, okay, what are we saving as far as if those people did their return by hand and mail it in and process at the service center. So, of course, the bigger your site is, the more your returns you do, the IRS is happier because the cost per return goes down. QNS and CAPS. This year, folks, the ordering system has been a major problem. I'm still processing orders that you guys have sent me because of the fact that the cost of paper went up. The printing costs went up, and then they had issues with the government contractor. So what IRS said was at the beginning, they said we were allowed to order last year's number plus 10%. Or pretty much, whether we're talking training books or stuff like that. Then what happened was, because of these higher costs and everything like that, they put a freeze on everything. So you couldn't order anything really. And they went and said, okay, well, we're gonna only print stuff at last year's numbers. We're not gonna add an additional 5% to that. And some stuff, now like for records envelope, which doesn't affect you guys, they're only gonna print them at 75% of last year. So their thing was, with like a records envelope or something like that, if the taxpayer comes in with last year's envelope, you don't need to give a new envelope every year. You can just put, this year's return in with their other returns, and then they keep all their returns together. Even with the intake sheets, this year, well, I don't know, you guys get your own, so it's a little bit different. But the VITA ones, they're the same color as last year. And what they said is if you have leftover intake sheets from last year, you can use them this year. The only difference is one line on the second page where it asked about the advanced child tax payments. You would have to, the question's not there, you'd have to ask the taxpayer. But otherwise, so people have leftover intake sheets, they could use those. Now, you guys are probably a little bit different with AARP, I'm not sure, but that's how it is for VITA. So this week, before the end of the week is done, I have to go back in and check on all the orders, the ones that I put in, and if they're stuck or something like that, I've got to redo them. So you may have gotten something from IRS Publishing saying, okay, you're going to get the 1040 instructions and you're going to get this and that, but you're looking for them to tell you when you're going to get your books. Well, that probably won't happen until the end of this week. So when you'll get them? They don't even plan to ship anything until the end of December, end of November, beginning of December. So all you have right now are just the electronic versions of the 4012, the 4491, and the 6744. There's talk here about doing away in the future with the 6744, at least as far as printing it, because most people do Lincoln Learn, and they're like, well, if you do Lincoln Learn, the questions are right there. What do you need the printed booklet for? Granted, if you wanted to do this stuff ahead of time, you can certainly get the electronic version of the 6744, which has been out since the middle of October or whatever. So, and that stuff's always going to come out a month and a half before Lincoln Learn ever comes up. So, and it's another way for them to save money. 1040 instructions. Well, they cut 1040 instructions printed back to just the VITA program, and that includes you guys. But really, the stuff that's unless you're doing a return by hand, how useful are the 1040 instructions? And you're not going to have them probably until either end of December, beginning of January. So the plan this year is they're still supposed to print them, as far as I know. But you can order them one per site, not one per person. So I know when I looked at a lot of your orders, people ordering, pretty much 1040 instructions per person. Well, that's not going to happen. I'll cut that down to 3 or 4 at the most, for depending on how many people you have. But really, the only thing that's of value in there, unless you're going to return by hand, would be to have the tax table and the EITC table. But this probably be for sure the last year of printing 1040 instructions, and then they'll go just like the Pub 17 went to. To being electronic only. And really, they've ripped the guts out of the Pub 17. If you looked at it last year, it went from, now it's like just right around 100 pages, because they're referring you in the Pub 17 to all the specific IRS publications, where Pub 17 used to have a lot of general information. And then if you really wanted to go in depth about the rules on a credit or deduction or something like that, it would send you the specific IRS publication. So it's not like that anymore. IRS equipment. You guys aren't using any IRS laptops this year, which is great. They've cut back the number of laptops now that are in the program. They're nationwide. I think we're down to like 2,200, where before we had like over 6,500. So they've taken a bunch of the old computers that they said no longer work all that great with Windows 10 or whatever, and they've gotten rid of them, and it's just the newer ones. Well, granted, they're at least 6 years old or 6 years old because they lived, with an employee for that, and then they put them out to, pasture with the VITA program. But you guys don't have any laptops, but some of you do have printers. If you don't need those printers anymore, you don't want to use them, let me know, and I'll get you a UPS label to ship it back to the office. But those of you that are using them and still hanging on to them, they want to try to get all the PLAs, which is the loan agreement, happening in the same month or 2 months. So we'll probably issue you, unless you're going to return it, we'll issue you a new PLA for either the end of November here or the beginning of December. That way they all expire within a 2 month period instead of different times of the year. If you need new cartridges for the printers, if you're starting to hang on to them, let me know. I'll ship you a cartridge. As far as the old cartridges you have, we don't have a program for refilling cartridges or anything like that. Years ago they did, but they did away with that. So basically, IRS owns the printer, but you guys get the cartridge, and once you use it up, I would say take the empty cartridge to Staples or someplace like that where they recycle them, and maybe they'll give you a ream of paper or $5 store credit or something like that. That's much better than throwing that cartridge in the trash. So, I'm not saying throw the cartridge in the trash. I'm saying, IRS doesn't want the cartridge back once it's empty. So take it somewhere where you can recycle it, and if you can get something for it, like a ream of paper or something like that, then that's fine. But we don't have a refill program. Okay, next slide. Just for, a reminder for referrals, if you've got somebody who has an issue, they've tried to work it through with the IRS, and they've gotten stuck or having a problem or something like that, they can go to the Taxpayer Advocate, and you have the Taxpayer Advocate information there, their phone number. Basically, that's a nationwide number. You call that number, then they'll reroute you to the local Taxpayer Advocate, which is pretty much by state, unless you live in a really large state. Like, well, here in Pennsylvania, there are 2 Taxpayer Advocates. There's one for the western half of the state, and there's one for the eastern half of the state. And one's in Pittsburgh and the other one's in Philadelphia. As far as the Taxpayer Assistance Center, those are the walk-in offices. They are open again, although you have to have masks and stuff like that. Like the one in the downtown Federal Building here in Pittsburgh is open. You can go in there and get forms. You can make drop-off payments, stuff like that. But if you're there for a account-related issue, you have to make an appointment in advance. And that's only because they were just staffing it with one person. Well, now when I was by there last week, there were more people working in the TAC office. So I'm not sure exactly what their procedures are and everything. But I know if you're there for an account-related issue, you're not just there to get a form or drop off a payment or something, that they can just give to you or whatever. You have to make an appointment. And if you go to the website, it gives you the nationwide number. Then you call that number, and they'll either try to answer your problem over the phone. But if you want direct face-to-face, interaction, then they'll say, okay, well, here's where your local office is. We'll set you up an appointment for such and such a time, and then you go there and you can see the representative will be able to share with you right on the screen whatever your account related issue is. Okay. Next slide. Next slide. Okay. This year, because of the 15th falling on the weekend, you have the Emancipation Day down there in DC. You have the Patriots Day up in New England. They decided to move the filing deadline from April 15th, which is the regular date, to Monday, April 18th. So we get an extra 3 days. Okay, next slide. Now, some of these changes to the tax forms are actually there, have been there in the software for some time, and some of the stuff is new. So let me just take one thing at a time here. Okay, they've made a lot of changes to EITC, and you're going to see this as we go through this presentation. They're trying to get more and more people EITC to help them out because of the virus and everything. So you're going to see more people are getting EITC than ever before, and they've increased the numbers. When we look at the slide for the numbers, some of the numbers are like, 2.5 times what they were before. But they've got this new thing in here for, you can get EITC now if you're under the age of 19. Before, under old rules, you had to be at least 19, but under 65. If you didn't have a kid, if you had a kid, the age didn't matter, all that. Well, if you're a qualified former foster youth or a qualified homeless youth, and you're under the age of 19, and you're working, you could get EITC. So this is trying to help, I guess they're trying to help people, get off the street and everything like that. The 4491 says qualified former foster youth. I don't know if these people have some type of certificate or something like that. I mean, how would I know, unless they told me that they're, I had to take their word for it. How would I know they're a qualified former foster youth or a qualified homeless youth? It's a little gray because they don't define it. As far as the child dependent care credit, there are a bunch of changes for child dependent care credit. In the past, your married filing joint people couldn't take it. Well, now they can if they meet certain requirements. Basically, they have to have lived apart for the last 6 months of the year. They can't live in the same household, and they have to be having a child. So they don't want to penalize the people for having care for their child so they can go to work, or if the child's disabled or somebody else is disabled, so that they can go to work, because they want to get people back to work and everything like that. So they're allowing married filing separate people for the first time to be able to take this if they meet certain requirements. Also, for the first time with child dependent care credit, it is now refundable. If you lived in the U.S. more than half the year. In the past, it was a non-refundable credit. They've also increased the limits and stuff. That'll be in a future slide. But so really, just as far as you need to know, there'll be 2 new boxes. But depending how you answer the questions in the software should fill in these boxes for you. Or if you're married filing separate, it'll come up and ask you, did you meet these qualifications? And if you do, then it'll allow you to check that box. Okay, next slide. They made some changes here to the 1040. Now, a lot of this stuff that you're seeing here on this slide has already been in the software. Such as on Schedule 1, they added the new lines for A to Z for income and for adjustments. Those were all the obscure sources of income and obscure adjustments, such as, jury duty and stuff like that. Where in the past, we had the dotted write-in line, the way it was in a form, and that's still there. Like line Z for each one of these is just the dotted line where it's not like one of the listed items above. Well, in the software, we always had all those individual options, and then you would check the one or fill in the amount for that line, and then it would put it on the write-in line. Well, they're trying to do away now with write-in lines on all these schedules. So they've added a whole bunch of new lines to it, uh, and broken down what exactly that income is. And the only difference is, like I said, that they've taken away the dotted fill-in line and just made a line for that item, unless of course the write-in line is still there if you've got something really way out in left field that you can take his income or an adjustment that they didn't plan for. So like they leave that in there for future use, but pretty much, you're talking like 24 different types of income, 26, I guess it is. So the ones we're used to seeing, like, with other income would be like the gambling and the jury duty and stuff like that. Well, now those will show on their own specific line on the Schedule 1. As far as Schedule 2 goes, they're trying to do away with these check boxes and stuff, like I said, and simply put in specific lines and take away the write-in lines. Also, we have a new line there on Schedule 2, which is for your payments and taxes that you're going to have for people who have to repay advanced child tax credit. Now, we'll talk about that for just a minute. Stimulus payments. Okay, if you get more stimulus payment than what you were entitled to, you get to keep the difference, okay? But child tax credit is a different story. If you had that child on your 2020 return, okay, and now you're not going to claim that child on 2021, but you had those payments advanced to you from July through the middle of December here, you will have to pay back that child tax credit. So stimulus, if you get more than what you're supposed to, that's fine, you can keep that money. They're not going to come after you for that. But advanced child tax credit is different, and you will have to pay that back. Okay, next slide. They also made some changes to Schedule 3 here. So they added a new line because, remember I told you, for child dependent care credit, it is now refundable if you meet certain criteria. Granted, if you can't use it all up at non-refundable, you can pick up the difference as a refundable. So that they had to put a new line on there for. Also, for your self-employed people, there's the sick and family leave credits. It makes a difference when they took it, so they have to tell you when they took it, and they have to have documentation to prove, because whether it's they got sick or and they couldn't work, or a family member that's a dependent got sick and they had to care for that person and they couldn't work. So and it depends on when it happened, because the amount per day is different. Basically what they do is they take their income for the year and divide it by 360, or I think they were only looking at it, how they did it last year was only looked at like 9 months or something. So they took their income for the year and divided it by whatever, 240, whatever, and that came out to what they made per day, and then gave them a credit for that. But there are limits on how much they can get, and that's on another slide here that we'll look at. But because they made it refundable, they have to put a new line on the form. So it makes, and like I said, with these family leave, it's pretty rare too, because the type of person that will do in the VITA program that's self-employed is generally a very small self-employed individual. Granted, I mean, like, the handyman is a common one. A lot of the people aren't going to meet the criteria because of, if they have any employees, well, that throws them out. If they have inventory, that throws them out. If they have expenses more than $25,000, that throws them out of the program. They can't have a loss and stuff like that. So we're focusing on that, person with a very small business that fits the VITA criteria, and whether or not, but they could still be, partially, maybe they lost their job, they became they turned their side, hack into, a business, and then something happened with them or their family, and they couldn't work because of COVID, and for a period of time, whatever it is, but they have to have documentation that they were sick, or, that they were caring for a dependent that had the virus. Okay, next slide. Now, there's a change here with EITC, okay? If you're married filing separate under certain conditions, and it's generally the same conditions as what it is for like you lived apart from your spouse for the last 6 months of the year, you didn't live in the same household, you have a dependent, and you're supporting that dependent. In the past, if you were married filing separate, forget it, you couldn't get the EITC. Well, remember, with this year, they're trying to get more and more people that earn income credit. So, and encouraging them to work. So, they're allowing now married filing separate people to claim the earned income credit if they meet all the rules. So they've added a new box at the top of the Schedule EIC that says, it says check here if you're married filing separate and you meet all the rules that apply on page 2. Because they've moved the instructions and stuff to page 2, but in the software, we usually don't print page 2 because it's just a page of instructions and stuff like that. The information that's on the front of the schedule, which is the children's name, the year of birth, the number of months that they live with you and stuff like that, that is actually the form that gets sent to the IRS. So you have a new checkbox at the top of Schedule EITC if you have married filing separate. Injured spouse, they took off the line on the injured spouse form for the exemptions because remember the exemptions are suspended here until end of 2025. So why bother to ask people about exemptions if they can't use them? So they took it off the form. Also, what they did was separate the credit section into basically like a 2-page chart to say these are the refundable credits and these are the non-refundable credits. And that's to help the processing for splitting up income and stuff like that. And your injured spouse, don't confuse injured spouse with innocent spouse. Injured spouse, here you've got a married couple who are filing a joint return together, and one of them owes money to the IRS or to the federal government or to the state. Most commonly is back child support or something like that. And they know, okay, well, if I file this joint return with this person, they're going to take the refund to pay this back debt. Well, if I file for an injured spouse claim, when I send in a return, they'll freeze the return, then they'll split up the income, and they'll give the person who is being injured, which is the person who doesn't owe the money, their share of the refund, but then keep the other part that belongs to the person who owes the money and apply that towards their debt. So people say innocent spouse and injured spouse all the time, but they're two totally different things. Innocent spouse happens later on after you file the return. IRS comes back and assesses additional tax because you didn't report income or something like that. And that other person could say, well, I had no knowledge of that, or I didn't know so-and-so was gambling when they told me they were supposed to be at work or something like that. And they didn't share that information with me, so I didn't know about it. And it allows them, IRS won't come after that one person for it, but they'll go after the other spouse to collect the money. Okay, next slide. The Schedule 8812, wow. What used to be 2 pages, folks, is now 4 pages. Because they really changed the 8812. They moved a lot of stuff from there. Your child tax credit will now be calculated on the 8812, where in the past it was done on the worksheet. Your credit for other dependents will also show on the 8812, where before it was just done on a worksheet. The additional child tax payments, additional child tax credit, which is, if you don't have as much tax, you can pick up the difference. That is calculated on the 8812, which is what it was always used for before, because the 8812 was the additional child tax credit form. Also, those advance payments that people got of the child tax credit will also be reconciled on the new 8812. So there's 4 new things, well, really 3 new ones that have been added on there. So they expanded the 8812 to, I know it's at least 3, it might be 4 pages, but it's more than the 2 it was before. Okay, next slide. Now this is about 2022 forms. Normally I wouldn't care about that, but if you're working with somebody and they owe money or they want to change their withholding, they've changed the W-4 forms for 2022. So if you're going to tell that person, well, just go change your W-4 with your pension or your IRA or whoever it is or whatever. There's 2 new forms now. We have the W-4P and a W-4R. The difference is, and the most common one is going to be W-4P, which is for receiving periodic payments and stuff like that. And the W-4R is for non-periodic payments or eligible rollover distributions. So it helps them. Just don't tell the person, well, just go change your W-4. You might have to tell them, okay, well, now there's 2 forms depending on what the source of the money is. So that's why I threw that in here. Normally I wouldn't care about 2022 forms, but because you guys I know do, refer people to, recommend that they change their withholding or something like that, especially if they owe now, and everything's going to be pretty much the same in 2022. You don't want people to owe. So if you can help them plan for it, then they, we want people to break even or get a small refund. We don't want people to get a giant refund because that's money they could have used during the year. We don't want people to owe because they may not have the money to pay the bill. Okay? So next slide. Okay, changes to the child tax credit. And there's another slide later that has even some more changes. But let's keep it simple for right now. Child tax credit was increased from $2,000 to $3,000. And you kind of have to think differently this year because they've included the 17-year-olds, where it used to be it was a child under the age of 17. Well, now it's a child under the age of 18. Okay? And it makes a difference how old the kid is. Because if the kid is from age 6 to 17, you get $3,000, okay? But if they're age 5 or younger, you get $3,600. Okay? They made the child tax credit fully refundable now. So it still has the non-refundable component. So you try to use up as much of the non-refundable against your tax as you can. And then the difference, so let's say you've got a kid, you've only got $1,500 of tax and your child is 12 years old. Okay, you get $3,000, so you're gonna use $1,500 of that non-refundable to wipe out your tax. And then the remaining $1,500 you would pick up as the additional child tax credit, and that is now refundable. Whereas in the past, you could only get like $1,400 of that refundable. And if you went over that, per child or whatever, well, now that doesn't apply. For 2021, the whole difference could be refundable to you, although there are some income limits that we'll see later on another slide. But unless you're dealing with people at that income level, for regular people, the average, person or whatever, you're gonna get the child tax credit could be they could receive the full amount. Also, I can tell you here over the summer, I've got a couple calls from people that are like, grandparents are raising their children. They claim the kid on the 2020 return, and they started getting these payments. And they're like, well, we don't work or anything like that. We shouldn't be getting these child tax credit payments. Well, in the past, you had to make at least $2,500 to get the child tax credit. For 2021, they removed the income requirement. So those grandparents that are raising their grandchildren, even though they're retired and not working, can receive the child tax credit because there's no income requirement now, at least for 2021. So that's something new that people in the past may not have, now if they were working, that's fine. They could get the, EITC, get child tax credit and everything, but they've removed that, income requirement. So that throws a lot of people off because they're not used to receiving this, credit. Also, those advance payments that they got, from July through December, they come out on the 15th of each month. They have to claim those payments, and then that offsets against their total credit. So they only gave them half a year payments, and they're $300 a month for each child. So the most you could get would be $1,800 per child. So if the credit is $3,000, you would still pick up the remaining $1,200 when you file the tax return. However, remember, we're talking child tax credit here. We're not talking stimulus. So if you got more advance payment than what you're entitled to, maybe the child doesn't live with you or something happened, you will have to repay that child tax credit. Stimulus money, you get to keep it. Child tax credit, you get more than what you're entitled to, you got to give it back. Okay, next slide. This is something totally brand new here, this first item. Okay, as far as, and we don't see this very often, where you've got the single or you've got the married filing joint taxpayers, they got socials. And in the past, you remember they had to be age, 19 through under 65. If they had children, then they don't no longer qualify. But if those children had ITINs, you couldn't claim the EITC on the children with ITINs. That is pretty rare, okay? More commonly would be, we had the other way around, is where mom and dad, one of them had an ITIN, and the children had social security numbers because the children were born here in the U.S., yet mom and dad came from somewhere else. In that case, they couldn't get the EITC. Well, they've changed it now and said, okay, well, if the parents qualify, but the kids don't, we'll now allow those parents to claim at the no child rate. So we'll just ignore the children and we'll let them get the EITC at the no child rate, as long as the parents have socials. Okay? Investment income. And there's a slide later that defines investment income. Investment income originally at the beginning of the year was $36.50. But in the summer, they changed the law when they changed this stimulus stuff or whatever. They've now bumped the investment income up to $10,000. So it's going up like 2.5 times of what it was. Because they're trying to get more people EITC. And what they've done is now it's specified that it will be indexed for inflation for future years. So though it was indexed for inflation before, and it would go up like $50 or $100. So I don't see what the deal of making a big deal about it being indexed for inflation for. Whether we stay though at the $10,000 rate going into 2022, or come back down to where it was around $3,600, $3,700, we don't know that yet. But for 2021, it's $10,000. Then you have the information here about, for the married filing separate people, how they can get the EITC, where before they couldn't get it. But now for 2021, they can get it. So they have to have a qualifying child who lived with them for more than half of the year. They have to have lived apart from their spouse for the last 6 months of the year. And they have to be legally separated under a separation agreement or decree and live in different households at the end of the year. And they have to have some type of document or whatever. They don't have to show you the document, they just have to tell you that they have it. That will allow married filing separate people that never got EITC before, if they meet the criteria to get it. Next slide. Okay, more stuff here on, now this first line was, I tried to put that on the other slide, but it wouldn't fit and it would have got too small. So I know this is EITC. We had this issue last year where, because people are out of work and stuff like that, and they're collecting unemployment and everything like that, that doesn't count as earned income. So what they allowed them to do was they could use their 2019 earned income only if it was more than what their 2020 earned income was. Well, the same rule applies now here in 2021. You can still use your 2019 earned income if it was more than your 2021 earned income because you might have been out of work or unemployment or something like that. And that's to get people more earned income credit, because remember, earned income credit, you've got to meet the criteria first for earned income, and then your adjusted gross income must also be under the limit. So it's a double check, and then they look up the figure, and whichever figure is smaller is the one you get. In the software, though, it asked that question. I believe it was they added it to the basic information section. So if you want to go ahead and, if the person gives you their 2019 figure, just go ahead and stick it in there. The software will automatically calculate whether it benefits them to use the 2019 or not. The problem is they have to have that information. So if they didn't bring their 2019 return with them, you're not going to know how much what their earned income was for 2019. Now, granted, if you did them, prior 2 years in TaxSlayer, you could jump over to 2019 and look at it, write down the figure, come back and enter it. It's your call. But, it's hard enough to get the people just to bring last year's return with them, not alone to bring 2019 with them. But you could ask them, hey, were you making more money in 2019? The person says yes. Well, do you have that return? Or if it was done at your site, well, then you could go jump over to 19, get the figure and come back, and it may benefit them. So, okay, stimulus payments. We're talking about the third stimulus payment, which was the payment that went out. When did that go out? March? Yeah, I think it was March. End of March. That was the payment of $1,400 per taxpayer, or married families don't have to be double that, and eligible dependents. Those are people that were claimed on the 2020 return who were a qualifying child or a qualifying relative. Because under the old stimulus, you couldn't get anything for, you could get for a qualifying child, you couldn't get for other dependents. Now you can. So the problem here is people got that money back in March. You're not going to probably see them until the beginning of February, and it's just going to be like the same like last year. If they got the notice and it came on a blue piece of paper, I forget what the notice number is, but it told you how much you received as the third stimulus. I know I got mine like the end of July, and then it says, okay, hold on to this document until next year when you do your taxes. Okay, if you ask me right now where my notice is, I don't think I could be able to pull it out and tell you. But I know how much I got, People might have forgot about that and didn't realize that they were supposed to keep that form until, they go do their tax return months, 8 months later. So it's just going to be like last year. You're going to have to ask them, okay, well, how much was your third stimulus payment? You can look at last year's return and kind of figure it out. Hopefully they can tell you, well, we got this much for so-and-so and everything. Or they bring in the notice, that would be awesome. The app is still up on the website. They're supposed to keep it up. Hopefully they don't screw it up like it did last year, where you could go in and you could put the person's information in that app, and it would then tell you how much they received. If they aren't sure, try to figure it out the best you can. If they say, well, I got the payment for me, but not for my spouse, then they can claim the recovery rebate credit, but you're going to have a repeat of last year, where anybody claiming recovery rebate credit, those returns are going to come in, they'll be processed, they'll be frozen, and then a real live person at the IRS has to go in and look at each one of those returns, make sure that you didn't receive more than what you're entitled to, and if you didn't receive the payment, then they will release that recovery rebate as part of your refund. That, just like last year, unless they've made major changes, which I don't think is going to happen, it's going to delay a lot of people getting their money, just like it did this year, where some people filed in February and didn't get their payment until August or September. And they weren't too happy about that. So, you might want to tell them, especially if they're claiming recovery rebate credit, that it might be some time before they receive their refund, because it has to be looked at by a live person. The computer only works it so far, and then it freezes it. And I think last year they had 10 or 11 million returns that had to be looked at by people. So, they're still, I think, the last report I said, they're down to, 2.3 million returns that they are still trying to finish up here before the end of the year. Now, granted, from 11 million to 2.3 is 8 million some returns. But if you're one of those people in the 2.3 still waiting to get your money, you're not too happy. So, just be careful with that, claiming that recovery rebate credit. Child dependent care, they made major changes to child dependent care credit, at least for 2021. They've increased the amount of the credit. In the past, the credit went from 35% of your expenses based upon income down to 20%. Well, now they've increased that from 50% to the max, I believe, goes down to 20%. They've also increased the expenses. In the past, the expenses were limited at $3,000 per child. They bumped that up to $8,000 per child. And remember, with the child dependent care credit, there's no income limit on that credit. You can make millions of dollars and claim the child dependent care credit. So you're claiming, for a child who's under the age of 13 at the end of the year, or if the child or dependent is disabled, then their age doesn't matter. It's all about work, though. You've got to go to work. Somebody's got to care for your dependent while you're at work. Either they come into your home or you drop them off somewhere while they're being cared for. You can claim the child dependent care credit, but you have to be working. You can't. If you're not working, you can't claim the credit. They changed the phase-out rules for high earners because they expanded the phase-out. It used to be in the past, if you made more than like 45 grand, you were already at the 20%. Well, now they bumped it up to 125,000, and then you can still get the max at 125 grand, but if you go then over that, they slowly reduce it back down to 20%. And a new thing with child dependent care credit is it is refundable to you if you can't receive the full amount that you're entitled to as a non-refundable credit. The difference is refundable. Whereas before, it was only a non-refundable credit. Okay, next slide. A little bit more about the sick and family leave. Like, remember, this is only for our self-employed people. You need to know when the dates that they took the leave, because that affects how much they're entitled to. And there's a different set of rules, like before, I believe, the 1st of April of the year, and then after April. But then they give you the maximum amounts here. So the sick leave for the self-employed person is the maximum of $511 per day. They can't exceed that, but really they're going to take their income that they made for the year, divided by probably 360 or something like that, figure out what they make per day, and that's what they'll give them. But if they make a lot of money, they would go over this $511, they only get the maximum up to that. You don't automatically get the max. So, and then the family leave is different. That is a maximum of $200 per day. They also have to keep their proof that they were either sick from COVID or whatever, or that they were caring for somebody who was sick from COVID, or You can't just say, oh yeah, I was sick, you know, they have to have some type of documentation. They don't have to show it to you at the site, but they have to tell you that they have it in case they get audited. Okay, next slide. The premium health tax credit is still with us. So the important thing here is that they tell us that they have the insurance from the marketplace or from your state exchange. They have to bring in the Form 1095A. You can't do this without the 1095A. If you try to send a return in without it, I think it still comes in. I don't know if it causes a reject, but it frees at the service center. They'll send them a letter and say you didn't provide your 1095A. Fill out the send us a copy of 1095A and complete the what is it, 89 or 8695 form or whatever, the form for doing that. I'm not sure what the form number is off the top of my head. And then you would send that back, and then they would amend the return. For people who didn't provide the 1095A. But that's the important thing that they have that, because that'll tell you how much they got, what their cost of the, what their premiums were, what the cost of the silver plan was, and whether they received any advanced payment. Granted, they don't get it, it goes to their insurance company, but then they have to reconcile. And that even if they don't have to file a tax return, yet they receive the health insurance credit, they must file a tax return because they must reconcile that. Last year, they gave a change in the law where they allowed these people who had to repay if they got more money than what they were entitled to. They didn't have to repay it. That doesn't apply to 2021. If you got more money than what you were entitled to, you have to pay the difference back. But there are limits on how much you have to pay back. So, and there's a repayment chart. I gave you the page reference for the 4012. Also, when you're talking about the premium credit, they have to fall within 100% of the poverty level and 400% of the poverty level. Generally, if they're under 100% of the poverty level, they will qualify for Medicaid, and therefore they don't qualify for the health insurance credit. If they make over 400% of the poverty level, they don't qualify because they make too much money, and they would have to repay. So, but when you look at the chart that's in the 4012, it says in there poverty level chart for 2020. But we're in 2021, and this throws people off every year, especially new people. It's okay. The chart that's in the 4012 is correct because they run that on a fiscal year, so they do that for October of 2020, and that runs through September of 2021. So even though the chart says 2020, it comes out partially for the year before. So you have to use the prior year chart. So the same thing will happen like for next year when you get 2022 returns, it'll be the 2021 chart. I know people always seem to have a problem with that. Why is it 2020? They're asking me if it's a typo in the 4012. I'm like, no, it's right because it's on a fiscal year. It's not on a calendar year. They also throw in this new requirement here about people that are either were eligible for, they applied for unemployment. Whether they received any money or not doesn't matter. But if it was determined that they were entitled to unemployment, whether they received the payment or not, they're automatically considered to be at under 133% of the poverty level, which would get them then the premium credit as long as they don't fall under 100% of the poverty level. So basically what they're saying is if you received unemployment, you just say, well, I'm at the 133% level for your income. How that works in the software, I have no idea because we don't have the 2021 software even to see yet. But that is a new caveat for, because what they're trying to say, they're trying to get these people who would make too much money in their state to get Medicaid, but they might not quite make enough to get the premium credit, so they could at least get some health insurance if they had an issue. Okay? Next slide. This is a change for self-employed people. Okay, the self-employed person, when you're doing a return, they have expenses. Well, for food and drink, normally that's limited to 50% of what they paid. And they have to be away on overnight travel. Okay, if the guy's just out driving his truck or whatever during the day, and he stops at Sheets and gets a sub and a drink or whatever, well, he doesn't get to write that off. Okay, be different if he took a client out or something like that. But the people that we're seeing aren't schmoozing clients, you know. The change that they made is if you purchase the food or drink from a restaurant, you get it at 100%. So if you went to a non-restaurant, like a grocery store, and you bought your food or drink or whatever, it'd be at 50%. But if you went to a restaurant, it's 100% because they're trying to make a tax advantage for people to go to restaurants and get people at restaurants back to work and stuff like that. So this was an incentive for people to do that. The problem is, if you've got this person who does have this, okay, he probably didn't think to keep track of whether he ate at a restaurant or ate somewhere else. Now, if he's got all his receipts, that's great. You can figure out, okay, this is what you got at Giant Eagle, this is what you got at Applebee's or whatever. The restaurant would also be like like a fast food joint or something like that. But most people just come in with a number, and this is what my food costs were. So for the person that we see that Zinscope is relatively small, they generally don't have food and drink expenses because it involves overnight travel. But for your larger businesses where they're schmoozing clients and taking them out to lunch and stuff like that, and as long as you discuss work either before or during the meal or whatever, then you could count that. So that's why they limit those at 50%. But for this year, if you went to a restaurant, it's 100%. Also, they have that paycheck protection plan, which is generally is for employers that had employees, and because they had to cut back their hours or lay them off or something like that, they were still paying these employees. If they were given any loan forgiveness, that would be that's not counted as gross income. However, if they've got employees, they're not in scope because we don't do people who have employees and filing 941s and all that type of stuff. So they would not meet our scope to start with. But somebody would ask you, hey, I got some more of this money than what I was entitled to for the paycheck protection plan. They don't have to count that as income if it was forgiven. So I just threw that in there. I know it doesn't really apply to us, just making you aware of it. Next slide. Okay, the PATH Act. I kept this slide in here only because of the fact that the PATH Act came out in 2015, but it's still something that we need to remember. Now they have made some changes to it here. So now the teacher's adjustment, the teachers in grades kindergarten through 12 who work at least 900 hours per year, if they buy things for their classroom and they don't get reimbursed by the school up to the first $250, they can take an adjustment for that. Well, they've expanded that now to include, personal protective equipment as well as cleaning stuff that they need for COVID, such as, wipes and gloves and masks and the plastic barrier things and stuff like that. If the school would not provide that and you have it and you pay for it out of pocket, well then you can count that as part of your classroom expenses. Because they never really defined classroom expenses. Those were just simply things that you bought for your classroom that the school didn't reimburse you for. Well, they basically expanded it to say, well, now you can, these normally it was meant to be things like books and, decorations for the classroom and all that stuff. Well, they've included now the COVID stuff. Qualified charitable distributions are still with us. You give money directly from your retirement account to a charity up to 100 grand. You can do that. And the nice thing is you don't have to worry about itemizing to take that deduction. The state and local sales tax, you can take that instead of the income tax that you paid, which generally helps your older people who may not pay a lot of income tax, but they still pay sales tax. And still, you have the option one or the other, whichever gives you a better deal. Next slide. Thing with the PATH Act that's most important to remember is if you've got returns with EITC or additional child tax credit, remember it's refundable. I think they've also thrown in here to this, although the slide doesn't say it, if you've got the refundable education credit from the opportunity credit, or you've got the refundable child dependent care credit, those returns will also be held until February 15th, because the IRS is giving extra time for that information to come in from the payers so that they can match it up before they turn around and give you money. So just file the returns like normal. You want to tell the taxpayer though, if you're doing a return, say, I think they haven't released a date this year as to when you can start filing. Although I did hear something the other day about January 24th would be like the first day. That's not carved in stone, don't quote me on that. So basically there's like a 3-week period there where once you can start e-filing before February 15th, go ahead and do those returns like normal, but you want to tell the taxpayer, okay, we're sending a return in, IRS will accept it, but they're not going to process it until the 15th. So, you won't get your refund at least until, March 15th or 21 days from there, which would be the March 7th or something like that. So after the 15th, then they have that information to match up with, and those returns get processed like normal. So it's just if you're filing in those first 3 weeks, you want to tell the taxpayer, okay, we're going to submit the return and everything, but, they're not going to process your return right away. The earliest you get your refund would be March 7th. All right, next slide. I kept the alimony slide in here only because, just as a reminder, so if you're receiving alimony, it depends on when the alimony began and when you got divorced and everything like that. So if you got divorced before the beginning of 2019, you follow the old rules, which is where, you report the income and the payer claims the adjustment. If you got divorced in 19, going forward, at least up until the end of 2025, when we don't know what's going to happen. But if you got divorced from 19 going forward, you don't report the income, and the person who pays it doesn't claim the adjustment. All right. And then you hear the word spousal support. Well, spousal support is what happens during separation. You're not officially divorced yet or whatever like that. But if you pay spousal support, that is alimony. Okay. The exemptions. Remember, we still have them. They're in the background. They're hiding there. They've been suspended from 18 to 25 here. However, they do keep the exemption amount around because it comes into the gross income test for a qualifying relative. And it is the same figure as last year at $3,400 or $4,300, I'm sorry. For some reason that one didn't get effective for inflation. Okay. The tax rates this year are still the same as last year. So you anywhere from 10 to 37%. Granted, rare that we see somebody, at least at the vital level, who is at the 24 or higher bracket. Standard deductions went up for inflation. They did increase them. So there you have the amounts for head of house or the married filing joint and the qualifying widower, the head of household, and the single and married filing separate. Those rates, single married filing separate, are half of the married rate. Also, if you have taxpayers that are age 65 or blind, they get the additional amount on top of their standard deduction. So that's $1,700 for a single and head of household, and $1,350 for married filing joint, qualifying widow, or married filing separate. Okay, next slide. Here's a change. This came out last year, where you have taxpayers who don't itemize, but they make cash charitable contributions to a recognized charity. Last year, you could take a $300 deduction. It's not an adjustment, it's a deduction because it comes in right before the standard deduction. There's a line on the 1040 for it. The only real change that they made this year is they allow now the married filing joint couple to take up to $600. Whereas last year, the married filing joint couple was treated the same as a single person, and their cash charitable contributions, if they didn't itemize, they could only take it up $300. Well, that wasn't right. So if they're married filing joint and they have cash charitable contributions, they can take that up to a limit of $600. Granted, it's whatever they paid. If they didn't pay $600, they only paid, say, $350 to their church or something like that, they can only take what they paid. But if they exceed the amount, then they get the maximum of $600. And that was just to fix what should have been done right last year, but wasn't done. So, giving the married taxpayer up to double what the single or the head of household would get. Okay, next slide. And the way you do that in the software is do it the same. If they tell you whatever their cash charitable was, just go into the Schedule A section, stick in what the cash charitable was. The software will automatically determine whether or not they're going to itemize or not. And if they don't, then it will give them the additional deduction on top of their standard deduction. Medical expenses are still at 7.5% of your AGI. So that is staying at 7.5%. They're not going to take that up to 10. A year or two ago, it did briefly go up to 10. Well, it came back down to 7.5. And for now, it's staying at 7.5. That's not going to change. They do limit the charitable deductions for high-income people between 30 to 60% of their AGI. Granted, if they don't get the full benefit, they get a charitable carry forward, but that's pretty high income, so it doesn't really affect us. Remember, your state and local income taxes are limited at $10,000. For some people, that's not hard to exceed that 10 grand, but because they're paying real estate taxes, they've got their state, income tax, got their local income tax, stuff like that. Especially if, both married couple and they both work and everything like that. Mortgage interest is deductible only on your main home, and you have to use that loan has to be either to buy, build, or improve your main home. Home equity loans and lines of credits, the interest on that is only deductible if they used it to buy, build, or, well, they're not going to use a home equity loan to buy their home, as long as they used it to improve their main home. So, you get a home equity loan, you can go on a vacation or something like that. In the past, they didn't care. Well, they changed that I believe a year or two ago, and said, okay, well, you can only deduct the interest on that home equity loan or line of credit if you use it to improve your main home. Okay? So they can use the money for anything, but they're only going to be able to take the interest deduction if it is used on their main home. Next slide. Private mortgage insurance, okay, which is not the homeowner's insurance. That is to protect the lender should you default. They extended that where the PMI is treated as interest for Schedule A purposes. So on the 1098 form, you'll have, if there's any PMI on there, there's a line for it. Stick it in the software, in the interest section, there's a line for it, and it will treat it then as interest. Your unreimbursed employee expenses, all that stuff has been suspended, so we don't have to worry about that until 2025. Your casualty and theft losses are only deductible if you're in a presidentially declared disaster area, and there's no limit on your itemized deductions anymore. Excellent. The qualified business income deduction. People, if they have a Schedule C, also I saw this with people who have some of these K1s, and they have real estate and stuff like that. It would allow them to get this deduction. It's a maximum of 20% of their net income from the business. It doesn't change the Schedule C. It doesn't change the self-employment tax. You have to use either Form 8995 or 95A. The software will automatically determine for you which is the appropriate form. The 8995 is the simpler version, and you have to meet I think 4 different criteria. And if you don't meet that 4 criteria, then you automatically go to the A form. We do have this with the people that have the little small self-employed business, or like I said, I've seen it even more now with someone with a K1, where they do certain real estate activities or something. And then there are income levels for that. The only thing that I question about here is I took this out of the 4491. It is the income level for married filing separate. Why it is $25 more than what the single amount is, I have no idea. That's the number that's in the 4491. It seems very strange to me because I figured that, okay, if you're married filing separate, they would give you half of what the married filing joint rate would be, which would be the 64,900. Why it's 64,925, I don't know. But that's pretty high income for what we see. I mean, that's it only goes up to 57,000 if they apply the strict criteria, or 58,000 this year. I'm sorry, 58. So, and the software would automatically do that, but I don't think that $25 amount is right. But that's what's in the book. So, and I couldn't find anything yet because the publication isn't out yet or anything like that. So, you might want to put an asterisk next to that. But the income is so high, though, that we shouldn't be really seeing those people anyway. Okay? Next slide. This talks about people here on the self-certification, about people who are going to handle their own rollovers. This ruling still applies. It goes back to 2016, where they're not doing a trustee transfer. They're moving the money themselves, which is not the preferred way to do it. But they do have 60 days to move that money from the one account to the other. And however, certain things happen along the way. They became sick. They didn't receive the paperwork. Family member died or something like that. And they deposit the money after the 60 days. That's when the penalties and everything kick in. They can claim some relief against that. But it's always better if somebody's talking to you, well, I need to move this money, or I'm going to do a rollover or something. Tell them, set up the account at the new place, and then have them send the money directly over where you don't touch it. And that's always a safer, better way to handle it. So that's a trustee transfer. But they do have the ability once a year to move money themselves, but you can really mess yourself up if you don't do it properly. So also, if there's withholding on that, if you say you move 100 grand, but they withhold 20%, well, you're only going to get a check for 80. Well, when you go to the other new account, you've got to deposit 100 grand. Otherwise, they'll treat that $20,000 that was withheld as a distribution to you, and you'll pay tax on that. Plus, you could pay a early penalty. If you did a trustee transfer, there would be no withholding. Okay, next slide. The traditional IRAs, this is unchanged from last year. So, it's $6,000, or if you're 50 or older, $7,000, that's the max. Of course, you have to have compensation. your compensation, which is your earned income plus your alimony income, is less than that, then you would only get up to the amount. Okay, next slide. The income limits for the traditional IRA went up, and these are the limits here if you're covered by a plan at work. Okay. They went up $1,000 or $2,000. Here you have the slide for if you're not covered by an employer plan at work, or if the spouse is not covered by a plan at work, the income limits are higher, and still be able to take the adjustment. Okay, next slide. And then if you're married filing separate, well, it's really tough because you can't make more than $10,000 of AGI. So it's hard for the married filing separate people to do that, but it is possible. Granted, if they made the contribution in the software, just go to the IRA section, input what they made. Now, they've changed that in the software. I think last year was they made the change. The traditional IRA contributions is in the adjustment section. So you would go to the adjustment section to enter just the contributions they put in for traditional. And when you do that, then the software will calculate whether they get an adjustment or not. For the Roth contributions, though, those you have to enter. You have to enter those on the Form 8880 form. You used to be able to do that under the IRA adjustment. They don't want that there anymore. So it goes under the retirement saver credit, because it only comes into play for the saver credit, because you get no adjustment for the Roth, being with the idea being all the money down the road is tax free. But for the savers credit counts your traditional and your Roth plus your 401k, 403b, that type of stuff that's picked up from the W-2. Okay, next slide. And then the Roth limits are the same. Now that's the total limit. So you can't put $6,000 in your traditional IRA and put $6,000 in your Roth. You can only do up to the limit, either one or the other, or combine them. Okay, next slide. And then you have the income limits here for the Roth. Okay, we can go next slide. And then also you have the rules if you're married filing separate. Depends on whether you live with your spouse or didn't live with your spouse. Next slide. Student loan interest, the maximum adjustment is $2,500, and then here are your income limits. In the software, they give you the 1098E. Just enter the total that they paid, even if it goes over $2,500. The software will automatically cut it off, and then it will apply for you the income limits. You don't have to worry about that. But if you're married filing separate, you can't do it. Okay, next slide. Long-term care premiums, these went up for inflation. If you're doing these on Schedule A, simply go to the section, put in what the person paid in their long-term care premiums, and the software will then automatically apply the maximums based upon their age. So you don't have to worry about any of that. Just put the total amount that they paid in, and it'll automatically cut it off depending upon their age. Next. The standard mileage rates for 2021. Business mileage rate is at 56 cents. So if you're doing somebody who's self-employed and they have vehicle expenses, those are 56 cents a mile. Your medical expenses, if you're doing Schedule A, they drove their vehicle or had somebody drive them, those are 16 cents a mile. I broke out moving because in the past it was medical and moving. I decided to make moving a separate thing here on this chart because only the military people can take moving adjustment. Regular people can't do it. And then your charitable, whatever charitable work you do, if you use your own vehicle or something like that, it's at 14 cents a mile. So if you do the canned food drive, you're going to drive around all the different places and pick up the cans and then take them to the food bank, wherever it is. You need to track that mileage. Any people need to keep a log of that mileage so that they can prove it. Next slide. The opportunity credit. The American Opportunity Credit is not really changed at all. It's the same rules as before. You got to have the 1098-T form because that tells us whether you went to school or not. It's only for the first 4 years of post-secondary education, so that means you're going to take it on 4 tax returns. And then it's for tuition and fees, plus the course-related materials, which would include the books and stuff like that. And you do that on Form 8863. Excellent. With the opportunity credit, they didn't change the amount, so it's still $2,500 per eligible student. That's the maximum amount. However, that is broken down into a refundable and a non-refundable component. So $1,500 is non-refundable, and $1,000 is refundable. And then there are income limits that apply, which are fairly high, especially for the PLED program. All right, next slide. Lifetime learning, they didn't change the basics of the lifetime learning, but you'll see on the next slide, they changed the income levels. So it's lifetime. I had a person call me up the one time, this a couple years ago, asked me how many years they can take a lifetime learning credit for. I'm like, are you serious? It's called lifetime, you know. But it's only for tuition and fees. You can only count the course-related materials if they are part of the tuition and fees. Okay, so it's like if you pay one price and they give you everything, then you can count but if they say, well, okay, here's the price for the class, and then you've got to go to the bookstore or go online and get your book, well, then that does not apply. So it's generally tuition and fees, unless, of course, everything is all paid, in which case you pay only one price anyway. And you also do that on the Form 8863. So the 8863 split in half. Opportunity credit is on the first part, and then lifetime learning is on the second part. Next slide. Okay, rules with lifetime learning have not changed. It's a maximum credit of up to $2,000 per return because it's 20% of the expenses up to $10,000. The big thing is they changed the phase-out limits. The phase-out limits now for the lifetime learning credit are the same as the American Opportunity Credit, and this is thousands of dollars more than it was before. I think it's going up. I want to say about 15,000 for the single person and like 30,000 for the married filing joint. So more people. Granted, these are higher income people that we don't generally see at the vital level, but it will make more people eligible for lifetime learning credit than ever before. And as long as, you know, they don't have to be pursuing a degree or anything like that, as long as they're taking that towards a degree, that's fine. But as long as they're taking it to improve or gain job skills, then they can do lifetime learning. So unless you're simply taking that course just for the fun of it, you never intend to use the course, you know, for work related. But if you say it the right way, it's kind of in that gray area where they pretty much give it to you no matter what, as long as you say the right thing. Okay, so be aware of that, the income limits on that have gone way up. The savers credit, they did index this for inflation a little bit up. It went up by either $1,000 or $2,000. So the retirement savers credit, you know, for people who contribute money to a traditional IRA, a Roth IRA, a 401k, a 403b, or some other type of tax-deferred retirement account, they may be eligible based upon their income to get the credit. Now the credit only looks at the first $2,000 that they put aside for retirement. However, if they took any money out of a retirement account, depending upon the type of account they took it out, that reduces that $2,000, and that's in the current year plus the prior 2 years. So they can get a 50% credit, they can get a 20% credit, or you get 10% credit. Don't see 50% because it's pretty rare, but with a married filing joint and head of household, you do see the 20 and the 10% more often than with the single person. But hey, if they put $2,000 away for retirement and they get a 50% credit, they get a $1,000 credit. Hey, that's saving them. That's basically paying them $1,000 to save money for retirement. It is a non-refundable credit though, so they must have tax. Okay, next slide. Earned income credit. Here you're really going to see some changes, mainly with the no income or the no income, no children. Okay. With no children, they bumped up the phase out amounts by about, I believe it's about $8,000. But the big thing is they changed the credit. The credit at the beginning of the year, the maximum was $539. They tripled it. It's up to $1,502 now. The one child, the two children, and the three children, those were just bumped up for inflation. Not huge changes with those, but it's the no children amount that went up. And remember, as long as people are working, we're going to cover those people 19 and above. So you might have senior citizens that are still working that are now suddenly getting child tax or getting earned income credit because they removed the age requirement. Of course, the software will calculate it for you, but you might just want to let these people know, hey, they never got this credit before because they were 65 and they're working. Well, now the age limit, at least for 2021, is gone. Okay, so those are the amounts for married filing joint. The only difference is the income limits are higher, but the maximum credit amounts are the same, and you'll see that on the next slide. So the income limits are a little bit less here, but the maximum credits are still the same as what they were for married filing joint. With the big thing being the no children amount being almost tripled. Okay, next slide. Remember, investment income has been increased from $3,650. Now it's at $10,000, and that is defined as interest, whether it be taxable or tax exempt, dividends, capital gains, royalties, rental income, and other passive activities. So, as long as you're under the 10 grand and you have earned income, you might be able to get EITC, where if you had a bunch of rental properties before, you weren't able to get that. All right, next slide. Health savings accounts. The health savings accounts are really unchanged for 2021. All they did was bump it up, I think, like $50 or $100 for inflation. So you have the amount there for the self coverage, $3,600. The family coverage is double that. Your people that are age 55 or older can contribute additional $1,000, and you want to report that information on the Form 8889. That's used for two purposes: to show what was contributed during the year by the taxpayer, and if they took any money out, they have to report. They'll get the 5498 SA. Yeah, it's 5498 SA when they put money in. That's only during the calendar year. And then when they take money out to pay for medical expenses, they get the 1099 SA. Well, put in what they contributed and what they distributed. Now, when they distributed, though, you have to find out whether or not they used that money for qualified medical expenses, which would be anything they could put on the Schedule A medical. And if it's equal to or more than what they distributed, then none of that money is taxable. But if they used it for a non-medical purpose, to say like, you took a yoga class at the gym or something like that, or you took swimming lessons or something like that, you didn't get a prescription for it or whatever, it's not going to be covered, and therefore it would be subject to a 20% early penalty and also be taxable. Also remember, if the employer contributes money to their HSA, that shows up on the W-2 with the code W, and that reduces the amount that the employee can then contribute on their own to the account and take the adjustment for. So in the case of a single person, the employer puts $1,000 in, I can only put in up to $2,600. Assuming I put that much money in, but I can't put in the full 3,600 because you got to subtract what the employer put in, and then that always tends to screw people up a little bit too. But on the 88, 89, the contributions are on the top part, and on part 2 is where you have the distributions. More common to see distributions than contributions, but if you have somebody hands you a 1099 SA, I always ask them, well, did you contribute any money this year? And then they can tell you what they put in. Okay, next slide. Kitty tax. I kept this in here about the kitty tax because you might do prior year returns. But kitty tax is out of scope for 2020 and going forward here unless they change rules. Because you need the parent's income and all that stuff. And it's taxing the dependent on their unearned income. So you know their dividends and their interest and capital gains, stuff like that. It was in scope for 18 and 19, so if you're doing prior years, it's in scope for that because those were taxed at the trust rates and the software has that built in. But you can't do the kitty tax without the parent's information. So that's why they decided to, when they made the change back in 2020, to take it back out of scope. Okay, next slide. Child tax credit. Okay. Remember in an earlier slide, we talked about how they bumped up the child tax credit to $3,000 if the kid was 6 to age 17, or it was $3,600 if the kid was age 5 or younger. Well, yes, that is true. However, if you make more than a certain amount of income, this is only meant for generally to be your low to middle income people. If you make more than that, they will reduce your child tax credit. I believe they reduce it by $50 for every $1,000 that you're over the amounts that are presented here, and they will reduce that child tax credit all the way down to $2,000. So let's say, for instance, you had a 12-year-old kid. Okay, your credit was $3,000, but you're single and you make $110,000. Well, probably at that income level, it's going to take it down to $2,000. So they only bumped it up really for the higher income people. And also the advance payments of the child tax credit were based upon, you had to be under these amounts. But that's based upon your 2020 tax return information. So yeah, let's say for instance, I'm single and I made $65,000 based upon my 2020 return. I got a kid and they gave me these advance payments. But when I filed my 2021 return, well, this year I worked a bunch of overtime. I made 80 grand. Well, I might get I might have to pay back part of that money, or my child tax credit is going to be a lot smaller than what I thought it was going to be. So the additional amount, that additional $1,000 or $1,600, only applies to your lower income people. Okay, and then remember, for the earned income credit amount, at least for 2021, there is no earned income credit, or there's no earned income amount. So you can get it even if you're not working, as long as you have children. So that's why you're going to see those senior citizens or the grandparents that are caring for their grandchildren, they're claiming them as dependents. They got these payments, or they're getting child tax credit, and they're not used to getting it because they didn't have any earned income. Well, that's because the limit now for 2021 at least is at 0. Okay, next slide. As far as the Affordable Care Act goes with us, the important thing that we have is the 1095A if somebody went to the marketplace. You may still encounter the 1095B from the insurer and the 1095C from the large employer, but we're not really going to do anything with those forms because they don't mean anything other than the fact tell me the person has insurance. But you want to keep them with their tax records, but it's only the 1095A that we have to enter something in the software for. Okay, next slide. All right, with the 1095A, if you've got marketplace insurance, you must file a tax return because you got to reconcile the credit on the Form 8962. Remember last year, they came along with the change and they told the people if you got more credit than what you were entitled to, you didn't have to repay the difference. That only applies to 2020. That does not apply to 2021. If you got more credit than what you're entitled to, you must pay back the difference in 2021. The poverty line guidelines are in the 4012. You got to be between 100 and 400% of the poverty level. And still, though, the individual shared responsibility payment, which is the payment for not having health insurance, is still set at 0. So yes, there is a penalty out there, but the penalty is 0. So if you don't have health insurance, you don't pay a penalty because it's at 0. Okay, so it didn't go away. All they simply did was made the penalty amount 0. Okay, next slide. All right, that's it, folks, and I didn't pull this information out of thin air or anything like that. If you want to reference it, of course, you have this presentation. I'm sure Pat will give that to you. But you can go back to the what's new section of the 4491, which is where I pulled this information from. There is some other stuff in there where they talk about expired provisions and stuff like that. I didn't include those. Also, when you're looking at that section, depending on what you're looking at, it'll refer you either to the specific chapter of the 4491 for more information, or there's a temporary provisions chapter. It will refer you over that for information just about the credit. Because they're trying to keep that with the way it would be from year to year, but if there's special stuff that applies just for 2021, then it will refer you to either, like I said, the specific chapter, or it'll refer you to that temporary provisions chapter if you want more detailed information. Okay, do we have any questions?
I have some here, Patrick. Questions and comments. I'll just start from the beginning of your presentation and work down. Ray Groy would like you to repeat the remote review forms you mentioned, the guideline for review.
That's the form 6729D, D as in David. You can get that off IRS. Well, you can get that off IRS.gov, but it is in the publication 1084, which is a site coordinator hand guide. Or you can ask your IRS contact for it, and we'll give you a copy of it. That way, like I said, you can do self-inspection right after you open your site, and then you know exactly what you're supposed to have up, and what you're supposed to be doing to be in compliance with the quality site requirements and the standards of conduct.
Okay.
The only difference between what's on that one form is about the 2 posters, but you guys use the D143 poster in place of the 2 VITA posters.
Okay. And Patricia G asked, and I think you answered this, where are we with the 6744 forms?
The 6744 is the test booklet?
Yes.
It's available electronically. It's been available electronically since the beginning of October. As far as in print, well, they're printing it now. So the earliest you're going to get it in print, I would say, is the week after Thanksgiving or the first week of December. It all depends on when your order was placed. Like I said, orders were all messed up and stuff. So I have to go back through here later this week and verify what was sent and what was not sent. So I would not count, if you're doing training or something like that, you want to have the books handy in print. I think you're probably looking at first week of December where you'll get them mailed to you. But you can still work with the electronic versions until that point.
Okay. Then Ray Groy asked another question. What do you think the recently passed infrastructure bill might have on the 2021 tax forms? Numerous changes occurred during tax season last year. Formulas, unemployment, etc.
Yes. Well, Congress has up until December 15th, actually, until they break for Christmas, which is right around December 15th, to make any changes that would affect 2021. At this point, we're not aware of any changes, but a lot of this stuff is, in order to get my vote, you got to give this or whatever, and they jam all that stuff into stuff that doesn't necessarily apply to what the name of the bill is or whatever. So I don't know. I can only tell you what we know right now. If any changes would come out as a result of late legislation, they will be included in the Pub 4491X that you will get probably X. Like, it looks like now the X will come out. Well, it'll come out electronically, I would say, right before Christmas. In print, it's not going to be printed at all. They decided to not print the 4491X. So you may not get it until the beginning of January. It all depends on whether or not they make any changes or whatever. But the X would be the corrections and updates to your training materials, such as your 4491, the test booklet, and the 4012.
Okay, then I had several comments on the third stimulus payment.
Okay.
Gary Rauschenberger stated that he checked the IRS website and was able to get the state status of his third stimulus payment using his social security number and street address, but it did not specify the amount. Then
and told him the date. It told him the date, but not the amount.
That's what it said. Yeah.
Well, that's about worthless.
Yeah. And there was a comment that would be a problem, like it was last year.
Yeah. Am I surprised? No. Basically, it devalues why we even have the app. But we're basically going to be then in the same boat. If the app won't tell you and the taxpayer doesn't know, you're going to have to quiz them. You have to look at the return. Granted, it's been like, what? I mean, if you do in April, it's been 11 months or so since they got that money. Hopefully they can remember that $1,400 payment. Otherwise, you're going to have to take their word for it. And if you give them the recovery rebate credit and they're not entitled to it, well, then it's going to significantly delay them getting their refund.
Yeah, that was a big problem last year.
Yeah, well, you're looking at the same thing this year because they haven't done anything. The only thing they've done is hire more tax examiners. Because when they did that last year, they did it in the middle of the filing season, and that's not the time to make changes like that. IRS doesn't hire generally in the middle of the filing season. So they've got more. They actually offered people who had tax examiner skills overtime or temporary reassignment to work those millions of cases. So, yeah, people were coming out of the woodwork and working overtime and stuff like that. So, I would simply say it's pretty much going to be like last year. Just do the best you can. Hopefully, you get it right. But if you're going to just be careful if you give them that recovery rebate credit, that the taxpayer understands that it's going to be quite some time before they get their refund. And if the IRS says they did get it, well, then they're not going to get that additional amount in their refund.
Okay. Then Patricia G stated as a note, she wanted to see if we have to add the $89.95 to our print sets.
Well, it should be there depending on what. I don't know. You guys use a custom print set, or do you use just the TaxSlayer copy print?
Some use custom. Go ahead.
Okay. If you use a taxpayer copy print, you generally don't get all the worksheets, and that's what you want to avoid. You just want to give the taxpayer what they need for their, to go home with. If you want to set up a custom print set, and you've already done that, and you're not sure that that form is in your print set, go ahead and go into TaxSlayer when you can and edit your print set. And like the forms are in numerical order, all the federal forms and the state forms. Just scroll down until you find that number and then check to see if you have a 1 next to it. If you have a 0 next to it, you're shutting down that form. But if you have a one next to it, it'll print one copy. Some places like to print, now this is a VITA, they'll print two copies of 8879, so they got proof that the taxpayer signed, and then the other copy goes home with the taxpayer. I know you guys don't, as a rule, general rule for AARP, you don't keep any documentation or anything like that, so that you wouldn't need to do that, but some VITA sites like to do that. Because they also keep the intake sheet and the copies of the W-2s and stuff like that. You guys don't do that, you give everything back to the taxpayer, but if there's a reject, depending upon what the reject is, you got to contact the taxpayer, have them come back in with all their stuff.
Mm-hmm.
Whereas the VITA sites, if they have the ability, to securely store that stuff, they'll keep the intake sheet and copies of the W-2 stuff like that.
Okay, then Regis asked a question.
He just knows his stuff. He doesn't need it. What's the
when will Lincoln Learn become active for testing?
When will Lincoln Learn become active? That is a good question. Well, I told you that they asked me here this afternoon to review the questions for the military and the international module. So, from what I've heard, and this is just a rumor, Lincoln Learn will roll out for 2021 here at the end of November, which will be right after Thanksgiving, or the first week of December. It's not going to be available before Thanksgiving, I can guarantee you that.
Okay, then Gary R. asked a question. Has the IRS software contract with TaxSlayer been renewed? And if so, for how long?
That's a 4-year contract. So when we went with TaxSlayer for the first year, that was a 1-year probationary thing. And then TaxSlayer was re-awarded the contract for 4 years. That took us up to where we are right now. Because when did we switch? I think we switched in 17. So 17 was for probationary year, 18, 19, 20. Okay, that was the first 3 years. Okay, so now 2021 is when they renewed the contract. So it's a 4-year contract. But I can tell you, realistically, these big companies like TurboTax, H&R Block and stuff, they don't want the IRS contract. At least not at the $550 that IRS wants to pay. They want $1,500. So yeah, they'll submit their bid every time it's up. But the only two that were really in the running were TaxSlayer and TaxAct. And TaxSlayer gets the chip because we're already working with them, and all of our training materials and stuff are already set up for them. So unless TaxAct would come along 4 years from now and offer it at a discount, I don't see us changing software packages. Okay.
Okay, one more question from
That's
Ray
not my
Moore.
decision to make. Just telling you what I know.
Is Practice Lab updated for the 2021 tax year?
When the Practice Lab comes out, it will be the preliminary version of the federal product. It will not, it won't be the finalized version. It'll be what TaxSlayer knows at that point. So there might be some things missing in it. The states won't be there. However, they have agreed with us to provide the prior year version. So the 2020 is also there in the Practice Lab. So if you wanted to practice with state, you could go over to the 2020 and do returns over there. Granted, they wouldn't be right for federal, for the most part, but it would give you some practice with if you wanted to do rebate, or you want to do the state tax return, or you want to do the local, and see how that works in TaxSlayer. That should be the same, because those are all flat taxes.
May I interject, Patrick?
Yes.
The TaxSlayer 2021 Practice Lab is there and available today. To what extent? I don't know, because I didn't actually go into it. But
Like
it
I
is
said,
there and available.
It's the preliminary version of the software that they rolled out. They'll be making updates probably weekly, but they won't add the states. They won't finalize it until usually around this January 15th. And then there's always a big update the weekend before you can start e-filing. I'm not crazy about e-filing that first week of January because there's always issues. I mean, if you start at the beginning of February, you're fine. But we've had some problems with returns filed that first week when they say you can do so because it just seems that not everything is right. But I don't know if that affects you guys, but it affects some of the Vita sites that they know as soon as the person gets their W-2 and that's all they have, they want their refund yesterday. And they're rushing off to, all these pay preparers, the internal blocks and Jack and Hewitt, stuff like that, to get their return done right away. So in order to prevent losing those customers, they open up as soon as they can. But we had issues with transmitting returns or something's not right in the software that first week. So if you do that, that's fine. Just be careful. That's all I can say.
That's all the questions that I see.
Oh, I see one more. Mary Ann has one.
Oh, yes.
Will the taxpayer need to provide the amount of the advanced child tax payments?
Yes. Okay, that's a very good question. They will have to tell you how much their advanced child tax payments were. Now, what's supposed to happen here in January, I don't know when, they didn't give an exact date. I would assume before the end of January, they will receive a notice that will tell them how much their total advanced child tax payments were for 2021. If they got those payments and don't tell you, Brand, you want to look at last year's return because that's going to clue you in as to whether they have a dependent, okay, which is a child, all right, has to meet child tax credit rules, and look at their income because I put up that slide what the income is. If they have that dependent and they're under those income limits, they should have received the advanced payment starting back in July. You have to ask them. I mean, it's $300 a month on the 15th of each month. Hopefully they can, if they don't bring the notice in, they can tell you how much they got. Or granted, if they got the advanced payments, but you said they didn't, well, when that comes in and the return processes, they'll match that up and then they'll reduce their child tax credit, which could reduce their refund. Well, would reduce their refund. So, but you can only go by the information that the taxpayer gives you. I mean, also, if they don't bring in last year's return, it's going to be pretty tough to see. Now, granted, if you have carry forward data for that person and that child's information comes over, you can ask them, okay, well, this kid on the return last year, did you receive these payments and stuff? Hopefully they have the notice, but you're talking about sending out a notice to millions of people. So whether that notice, gets there in time, I can't guarantee that. But just like the stimulus, do the best you can with the information that you have.
Okay, I don't see any more questions, so we really thank you for coming and helping us out today, Patrick. We were able to record this session so that I can easily pass it on to other volunteers if they want to watch it and try to answer their questions. And if they have questions that we can't answer, we will get the questions back to you for help. But thank you very much.
All right. Thanks for having me.
Mm-hmm. You're free to go.
All right. Bye.
Bye.
Yeah, Patrick.
Right. The rest of us, I think we will take a 10-minute break and then come back and hear a very short presentation from Frank about scope. See everyone back here at 12:10. One more minute and we will begin again. Ready to go. Frank has a presentation for us now about scope for the coming season. So Frank, when you're ready, take it away.
Okay, I'm going to go into the present mode now. Oop.
We lost Frank. He left the meeting.
Pat, maybe you can run the slides.
Sure. You're back.
Okay. I'm back.
Okay.
I clicked the wrong button.
That's okay. Okay.
Okay, go back to the beginning.
Sorry. Oh, sorry. Sorry, because I reviewed this myself this morning. Okay. There.
Okay, we're going to talk about scope changes for 2021 tax year. This is something most of you have seen and are familiar with. Go ahead, change the slide. Release 1 of the AARP scope manual is in the portal library. It's 24 pages long. The good part about it is there's no changes for tax year in 2021. And next slide is just a picture of what that scope manual looks like. Then the next slide is the format that they present. And this is just a sample of the 1040 form and what's in scope and what's out of scope. So next slide, please. Out of scope items for the 2021 tax year is the same as last year. And we'll just quickly go over those. Self-employment, if there are employees, losses, expenses that exceed $35,000. Depreciation of business use of the home. 1099 filing requirements or other complicating factors. The 1099 is one that seems to sneak up on us, at least in Indiana, that we'd be right in the middle of a return and look at a 1099 code and it would be out of scope. So it's a little embarrassing to send people out home then. Hobby income or other activities, not for profit. Complicated capital gains and losses, such as futures and options. Complicated Schedule K-1s. That's always an issue at times. Rental income, except land-only rental or rental of personal residence less than 15 days. Royalty income with expenses, if not from self-employment. Next item. Tax on child investment and other unearned income, the kiddie tax. Farm income or expenses are out of scope. moving expenses are out of scope unless it's military. Some investment income or itemized deductions that are not included in our training. Alternate minimum tax, additional Medicare tax, or net investment income tax. Foreign financial asset reporting requirements, and any virtual currency investment or transaction. In scope items, next slide. Okay, and wages, interest, dividends, capital gains and losses, unemployment compensation, pensions, sort of the normal stuff that we usually get into, Social Security benefits, self-employment income with limits, most income reported on Form 1099 MIS or 1099 NEC, Schedule K1 that includes only interest, dividends, capital gains, losses, or royalties, charitable cash contributions, qualified business income deductions. Next item. Economic income payments, AKA the stimulus payments, itemized deductions, including non-cash contributions to charity that total not more than $5,000, cancellation of non-business credit card debt, IRA contributions, deductible or not. Most credits such as earned income credit, educational credits, child additional credit, child credit, credit for other dependents, child dependent care credit, premium tax credits, simplified method for foreign tax credit, self-employment sick leave or family leave credit, and retirement savings credit. Repayment of first-time home buyer credit, estimated tax payments, injured spouse allocation depending on state, health savings accounts, amendments to filed returns, and prior 3-year tax returns. So these are all items that I think most of you are familiar with already. There's much more details in the portal. And so if there's any questions, I'd be willing to take them.
Trish has a question, but it's not about scope. I can ask it. It says she has a general question about certification. Given Patrick's comments, what is a certification schedule going to be this season? We're going to get into certification more on next Monday or Tuesday, Trish, if you can wait that long. Obviously, none of us are certified at this moment in time for different reasons. But I think that this is kind of like a wait and see. Hopefully all of us will be certified by like December 15th, before your training begins, before your home training begins for your district. Frank, do you have anything else to add on that?
No, I think you answered it correctly.
Okay. And in the meantime, because the workbooks, or not the workbooks, sorry, 6744s are barely in print yet, I guess, that leaves us to at least begin the test through an electronic format online. I know I've already started mine, and I did everything but the scenarios, and I just printed the answer sheet for myself to be able to use. I don't personally enjoy using the electronic version of 6744 when I have to do the scenarios. There's just too much looking back and forth unless I print those pages that I need. All right, Steve, your hand is raised. Do you want to unmute yourself and ask your question?
Yeah, just a quick question. Just Frank, going over the in-scope stuff and out-of-scope stuff. It appears to me there is zero change from last year.
That's correct.
And
Thank you.
Kathleen, your hand is up. You can unmute yourself and speak, or if it's your question that's there, we can just go ahead with it too, either way.
Yes, my question was, we've had a couple of ministers come in with, income from, their salaries from the church, et cetera. And then there's complicating factors with their housing allowance and that kind of stuff. And in the past, I thought that was out of scope, but you didn't mention it.
When I went through this, it was out of scope in the past. And I didn't notice anything on the most recent documentation. I wrote myself a note to check on it. So I will check on that and get back to you, get
Okay.
back to everybody.
Great,
But,
thank you.
I think it's still out of scope. I know we've had to turn away one or two.
Okay, thank you.
Good question, Kathleen, thanks. Anyone else have any questions before we sign off for today? Trish says she thinks we're not really trained on ministerial issues, and I would have to agree with her on that too. We don't even,
I
I don't even
agree,
know what those
yeah.
are. Yeah. Okay. So if for no other questions for this group, then next week's meetings are going to be at 1 p.m. on Monday and 10 a.m. on Tuesday. And I think Frank is also sending out some other invitations to the district coordinators for trainings opposite the trainings that I have scheduled. So I will
That's
see, excuse me?
That's correct, yes.
Okay. But I will see this full group in here again next Monday at 1 p.m. And I will send out an email later this week with information in it about homework and times and the agenda. Thank you very much for your attendance.
Same login code or Zoom
Yes,
code?
but I'll
for,
still include it in the email that I send out.
for the 10 a.m. one.
The 10 a.m. one we're going to do on WebEx. You'll be getting an invitation on that one very shortly.
Okay, thank you.
Mhm.
The meeting's over. You can come back again on Monday. Thank you for attending today.
Thank you.
Thanks, Pat and Frank.
Thank you both.